Can you save 70% on your Bitcoin taxes without breaking any laws? The answer might surprise you. On the TFTC podcast, Jessy Gilger, founder of Sound Advisory, breaks down sophisticated yet legal tax strategies for Bitcoin holders, drawing from his experience managing over $150 million in assets. In today's discussion, we'll examine 3 central points: how IRA structures can help you keep up to 70% more Bitcoin, why planning ahead beats reactive tax management, and how combining multiple tax strategies can maximize your savings. Before we continue, if you enjoy these breakdowns, hit the like and subscribe button for more TFTC content. Full episode linked below. Stay tuned until the end to learn how combining multiple tax strategies could save you hundreds of thousands in Bitcoin-related taxes. But first, let's dive into how the right retirement account structure could help you keep significantly more of your Bitcoin gains.
I'd say a young Bitcoiner's like, why do I need a Roth IRA? Doesn't matter if you've been building into IRAs for 20 or 30 years and you're going to be half of it's taxed and another 10% penalty and you live in California. So you're looking at like 60, 70% if you're a high income earner. Like you can have 60 to 70% more Bitcoin if you use an IRA structure, right? And if you've got the cynical down with the man, like I don't touch I'm no KYC to the core. You can be cynical of that, but that absolutely matters to that retiree. He's retiring in 2 or 3 years. All of his money's in a 401k or IRA, and he's looking at like, how do I get more Bitcoin? He will get more Bitcoin by using some existing structures rather than just like, let me ape out of the TradFi system, pay 70% tax, and now I have like 30% of the Bitcoin. Like,
here's the shocking reality of Bitcoin tax efficiency that most people miss. As Jessy points out, by properly structuring your Bitcoin holdings in retirement accounts, you can potentially keep 60 to 70% more of your wealth. This isn't about complex loopholes. It's about understanding how existing retirement structures can dramatically reduce your tax burden. Think about that number: 70% more Bitcoin simply by using the right account structure. For someone in a high-tax state like California, this could mean the difference between keeping most of your Bitcoin gains or watching them disappear to taxes. This is especially crucial for young Bitcoiners who might be dismissing traditional retirement accounts without understanding their powerful tax advantages. We just saw how the right account structure can help you keep significantly more of your Bitcoin. But timing these decisions is crucial, which brings us to our next point: why looking forward instead of backward can make all the difference in your Bitcoin tax strategy. And stick around until the end, where we'll explore how combining multiple strategies together could save you hundreds of thousands in taxes over your lifetime.
oftentimes that stress comes because the year's already over, right? You're in April 25. You're like, I can't go back and do anything different in, October of 24. So accounting is absolutely necessary, right? Getting your taxes right. Joe does a great job with his clients. We have mutual clients. Where we're a little bit different is we're often not like looking in the rearview mirror of what happened last year. We're looking 1, 5, 10 years down the road. Okay, what are the tax strategies coming up on the horizon? And DAFs are just, donor advised funds are a tool in that belt, right? Oh, we got X, Y, and Z in this case. Client's charitable. Maybe we need to look at doing a DAF and kind of front loading some gifting, choosing when we get our write-off for our tax situation. And then sometimes you're pairing that with other tools, right? So again, very specific case by case, but I'd say that's the major difference is a lot of CPAs are like, okay, what happened last year? Let's make the most of it. Good financial advice is looking 1, 5, 10 years down the road and be like, ooh, if we make this move, you're probably saving tens, if not hundreds of thousands of dollars, just from a tax perspective. It's not like a matter of opinion. Doesn't matter if Bitcoin goes up or down or sideways, that there's just structural things within the tax code. And you say, oh, okay, this exists. You need to do this, this, and this. You've got a better situation. And oftentimes that's why people are signing up with us, because it's not a matter of opinion. You kind of just point to the numbers like, hey, we can save you X and we charge Y. It's pretty easy to say yes. So
what Jessy's highlighting here is a fundamental problem in Bitcoin tax planning. Most people are playing catch up with their taxes instead of planning ahead. When you're scrambling to figure out last year's taxes in April, you've already missed countless opportunities to optimize your tax situation. This is particularly critical with Bitcoin because of its volatile nature and potential for massive gains. You don't want to be forced to sell Bitcoin at an inopportune time just to cover an unexpected tax bill. By planning years in advance, you can identify opportunities to minimize your tax burden before they arise, rather than trying to fix problems after they've already occurred. Think about this like playing chess instead of checkers with your taxes. You're not just reacting to what's right in front of you. You're thinking several moves ahead. Sup, freaks? This rip of TFTC was brought to you by our good friends at BitKey. BitKey makes Bitcoin easy to use and hard to lose. It's the easiest 0 to 1 step, your first step to self-custody. If you have friends and family on the exchanges who haven't moved it off, tell them to pick up a BitKey. Go to bitkey.world, use the key TFTC20 at checkout for 20% off your order. That's bitkey.world, code TFTC20. This isn't about tax evasion. It's about tax efficiency. There are legal tools and strategies available that can help you keep more of your Bitcoin wealth, but you need to plan ahead to use them effectively. We've now seen how proper account structure and forward planning can dramatically reduce your tax burden. But the real power comes when you combine multiple strategies together, which brings us to our final and most powerful point: how integrating various tax approaches can maximize your Bitcoin savings. Stay tuned to learn how layering different strategies together could save you hundreds of thousands in taxes.
Big one is retirement, and you'll have folks like working, high tax bracket, 1 year, turn it off, right? Just drop to like super low tax bracket. And so when we're paying a high rate and you've got a low rate now, sometimes you're doing Roth conversions, taking money from an old pre-tax account, choosing to pay taxes early, get it into a Roth IRA account, and you're paying a lower rate on those taxes. So kind of, I like to point out to clients like a Nike swoosh, right? You're making a lot of money, went down in a dip, and then in your 70s, you hit this government requirement called a required minimum distribution. Kicks in around age 72, 73. But if a client has a very large pre-tax IRA, and some of ours have, Bitcoin in them, right? And if Bitcoin does what people think and hope it could do over the next 10, 20 years, you're having to take that required distribution out of that pre-tax IRA. It starts at around 3 or 4%, but a lot of the scenarios we model, clients are likely approaching the highest tax bracket that exists. And so you take that opportune time while they're in the dip of that Nike swoosh, like, hey, let's choose to pay some taxes now or this lower marginal rate, get it into Roth, and then that Bitcoin is going to sit tax-free for that client's life. It can be inherited by the spouse tax-free, and then kids as well. So that's a big one. That's where I've seen 7-figure tax savings.
Now we're getting to the heart of sophisticated Bitcoin tax planning, understanding how to layer multiple strategies for maximum benefit. Jessy uses this brilliant Nike swoosh analogy to show how your tax situation naturally changes throughout your life. During your working years, you're typically in a high tax bracket. Then in retirement, your income drops significantly before potentially shooting back up due to required distributions. Understanding this pattern is key to implementing effective tax strategies with your Bitcoin. What's particularly powerful about this approach is how it takes advantage of these natural tax bracket changes. Let's say you have Bitcoin in a traditional IRA. You could face a massive tax bill later in life when you're forced to take distributions, especially considering Bitcoin's growth potential. But by strategically converting portions to a Roth IRA during lower income years, you're paying taxes at a lower rate now to avoid paying them at a much higher rate later. This is where combining strategies becomes crucial. Think about it this way. You're not just choosing when to pay taxes, you're choosing which tax bracket to pay them in. By understanding how these different strategies work together, you can create a comprehensive plan that keeps more of your Bitcoin wealth working for you instead of going to taxes. For Bitcoin holders, this kind of strategic planning isn't just helpful, it's essential for long-term wealth preservation. This combination of strategies, from proper account structures to forward planning to strategic conversions, represents the cutting edge of Bitcoin tax planning. By implementing these approaches effectively, you can potentially save hundreds of thousands in taxes over your lifetime while ensuring your Bitcoin wealth is preserved and protected for generations to come. What tax strategies will you implement first to protect your Bitcoin wealth? Let me know in the comments. I read every single one, and if you found these Bitcoin tax optimization strategies interesting, you'll want to watch our analysis of how Bitcoin empowers financial freedom. Click the video on your screen now. Don't forget to like and subscribe for more daily content. Thanks for watching. Stay humble. Stack sats.